the point is, when you invest in your brother-in-law's like crypto scheme, and you think, oh, I'm going to make 10,000% or lose everything, and the probability of the 10,000% is like 1% or less, and the probability of losing it all is very high. You have to be able to make these judgments, and most people cannot make these judgments. So I'm just trying to tell people, like, be rational about it. I'm not saying take no risk, but you need to be rewarded.
Hello and welcome to Get Yourself Optimized. I'm your host, Stephan Spencer. It is my pleasure to have David Leiter with us. David is a seasoned professional in finance and real estate with a career spanning over 2 decades. David's journey began in Wall Street in 1996 at Credit Suisse First Boston, where he was involved in syndicating substantial loans during the dot-com era. His experience in finance deepened as a proprietary equity trader from 2000 to 2003. David's real estate ventures in New York City have been a significant part of his career since 1998. He's successfully invested in and managed numerous residential and mixed-use properties, highlighting his expertise in the field. In 2010, he founded an HOA condo management company in North Brooklyn, managing nearly 100 properties and later selling this company in 2020. Retiring in 2020, David's focus shifted to educating others about investing. He started writing in 2022 to help people identify sound investment opportunities and avoid risky ones. His efforts were recognized when he shared the stage with notable figures at Tony Robbins' Platinum Financial event. I know David through the Tony Robbins Platinum Partnership. I know his expertise. I've attended some of his trainings. This guy's legit. So I'm very excited to have David on the show today. David, thanks for coming.
Thank you. It's great to be here, Stephan.
So first of all, I'd love for you to kind of give us the backstory of why you're training people on how not to get snookered, because there are some sharks out there, especially in some masterminds where you think that they're highly vetted and everybody's super legit and have impeccable values, and then you end up losing a lot of money investing in their schemes. So why is it that this is something that you're passionate about? What's the backstory behind that?
I had been investing. As I said, I started at on Wall Street in the mid-90s, and it was the dot-com bubble. And I was trained there in credit analysis and all this stuff. So I had some expertise. And over the years, I joined, I was in some certain groups where, as you noted, that people, there were great groups of people, but there was, during probably, the last 12 years, when interest rates were zero, everything was going up, and a lot of people got into the investment management business. And some of them really didn't know what they were doing, and they thought, a rising tide lifts all boats. They thought, they were really smart, and they were taking other people's money, investing it in startup type deals or all sorts of different schemes. And what happened was, over and over again, I saw people losing money investing with each other. And the reasons were either these people who were saying they were good people, maybe with good intentions, but they really just didn't know what they were doing. They were taking people's money. And again, everything was going up from the period of after the great financial crisis, for a period of 12 years, interest rates were basically zero. And that has a huge effect on all asset prices. So people got into the investment business, things went up. They thought they were geniuses. They took other people's money. So they were good people, maybe good intentions, but they had no perspective of cycles, and they lost people's money. They lost a lot of my friends, people I knew, people who didn't have a lot of money, even some had a lot and they lost, and I'm not worried about them, but there was a lot of people who didn't really have a lot who were losing. And then the other thing was there were some people who got involved with bad intentions. So they were raising money and they were just not legit deals. And so there was a small handful of those. So when I sold my management company in the end of 2020, I had a lot more free time. I was basically retired. I was living off my investments, and the sale of my management company was relatively small relative to my other activities. And but I was just very happy, and I don't know, I just saw again, I had more time, so I started, I just wrote this thing called the 20 Rules to Know to Stop Making Dumb Investments. And I wrote it for my friends. It was like a cheeky sort of title, and it was part humor, but it was a lot of truth. It was all true. And it was just like, hey guys, wake up. Like, this is ridiculous. And I was just sort of disgusted again. And it really came to a head with the crypto crowd, because in the crypto crowd, there was just all sorts of wild schemes going on. And I said it early on about like staking schemes where they tell you you're going to get 10, 20% a month in interest, or all sorts of wild claims, and it all imploded. So I really just was disgusted. I felt like I had, a lot of expertise in this area. I'd been investing since the mid '90s. I didn't, go broke from investing. I was sort of, from the Warren Buffett School, how to value investments, make rational decisions long term. And I did very well with it. So I thought I could help. So I started talking about it.
Yeah. And the stuff that you shared, like on WhatsApp, we're in some WhatsApp groups together and so forth. That's just really important wisdom for anybody who wants to do investing, and especially when you think that you're investing in vetted programs because you're in a vetted community, and then you lose, and it's just a painful wake-up call. One that I had many years ago when I first entered the Tony Robbins world and Platinum Partnership, where I made some bad investments that I thought were good, and I lost multiple hundreds of thousands of dollars, and that was a very painful lesson. But doesn't take very many of those, and you smarten up. So it's much better to learn from somebody else's mistakes than your own in terms of your own balance sheet. So it's good that you're doing this.
Yeah. Well, let me be clear. I love Tony. Like, the community is awesome. Platinum. I have a lot of my great friends in it. I mean, you mentioned it. That was one area, but it really, the issue is with, they can't be sure about every person, watch every person, what they're doing. So I don't blame the community. It was just sort of some people, or Tony. Tony's incredible. I learned a massive amount from Tony, but it was just like a few people in the group were trying to raise money from other people, and it just kind of, spiraled in certain cases. And but 99% of that group is awesome people, great friends, and so it was just sort of this small percentage was a representative of what's going out there in the world. If you turn on YouTube every day, there's somebody telling you absolutely the best thing. You're going to make a lot of money. There's people who make wild claims. And it was just like, hey, like, let's all smarten up. There's certain things that are just really low probability. They're really low probability. And most of every investment, I always say, no investment pro owner has ever said, invest with me and you're going to lose your money. Like, no one ever says it. Every deal sounds great. Everything that has ever been pitched sounds great. And there's people who are very shrewd and very smart who can make things look any way you want. I showed people, on some real estate deals that were promoted, I showed them with the spreadsheet by popular guys who are out there. And I showed how you could change the numbers just a little bit when you plotted it out, and the whole deal looks awful. It's all based on your assumptions that you're making. So, and you don't need to be a math whiz, but I actually have a real estate program where I was showing people that, and I can make projections look like anything I want. I also saw that at Credit Suisse. Now everybody operates with integrity, but there's a certain amount of range in assumptions that you can make, that you can tell people, say, hey, if you do this, you're going to make this return. But if you want to get smart about these things, if people want to get smart, you have to first realize that that's the way the investment industry is in a large part. And just because you see BlackRock promoting a crypto ETF or something, they want to make money. The fees are enormous. So you cannot just assume, oh, then that means it's okay. Or Kevin O'Leary is on TV saying, buy Bitcoin, or, it's and now he's saying not, by the way, which is very funny. When he hated Bitcoin, right? And then he got 15 million from FTX, and he loved Bitcoin. that's amazing transformation. 15 million changed his mind. And then now he says, he doesn't like it. So because that imploded. So it's like, it's hard out there. You got to be smart. I worked in real estate, finance, New York City, 30 years. If you're not smart and shrewd, you get crushed. And it's a tough market. So I was just trying to share that with people.
So what are some of the principles that you would share in a community like Platinum Partnership, or in your own private mastermind? Like, what are some of the key principles above and beyond the stuff that you would read explaining value investing and Warren Buffett's approach and investing in wonderful companies, and do they have a moat and that sort of stuff? Give us some immediately practical advice that you don't typically hear in the traditional media.
One of the key things when you're investing is you want to think in terms of what's called risk ladder. So all investments compete with what is considered a risk-free return, which is U.S. Treasuries. So when interest rates are like gravity, when interest rates are up, asset prices tend to fall because all investments compete. If you always remember that, professional money is always looking for the best return for the least risk. Relatively, some people take more risks to go for those bigger returns. But if you think in terms of risk ladder, treasuries are at the bottom. Right now, you can get 5% or, give or take in short-term treasury bills, 3-6 months. Now, those aren't great investments long-term because, as we know, inflation and all these things deteriorate your money. And in a high inflation environment, you don't necessarily want to own bonds. But if I can start at 5%, now if I go up the risk ladder, you have bonds. Different types of bonds are considered slightly more risky. Corporate bonds, municipal bonds, corporate bonds, high yield bonds. But as you go up the risk ladder, you need to get compensated accordingly. Then after that, you might have stocks, and then you have real estate, private equity. So real estate you own, or you might have private equity you invest with others. And then you have venture capital and angel investing. So as you go up, you're taking more risk. You need to have a reasonable expectation that you're going to get rewarded for that additional risk. For instance, let's say somebody comes to you with a real estate deal and says, Stephan, you're going to make, an IRR, an internal rate of return of 10%, invest in my real estate deal. Now you have to make a judgment and say, you know what, I can own a portfolio of bonds and get almost, around that same, maybe 6, 7 to 11, 12% on high yield, more risky bonds. And I can control it. I can sell them at any time. If I invest in this person's deal, it's illiquid. Maybe he makes wrong decisions. So you have to think about the risk you're taking relative to the return. So, and in stocks, when they're at high valuations, maybe the return is less. But think about this. You can own the best companies in the world through public markets. You can control them in your own account. You can own through an index if you don't know how to evaluate stocks. And, you would always be owning, if you're in an index, you always own the best companies in the world. Some fall off, some go up. And historically, that's been a good return through periods of time. Now, it depends on when you need the money because markets can go down or go sideways for long periods of time. But the point is, when you invest in your brother-in-law's crypto scheme and you think, I'm going to make 10,000% or lose everything, and the probability of the 10,000% is like 1% or less, and the probability of losing it all is very high, you have to be able to make these judgments, and most people cannot make these judgments. So I'm just trying to tell people, be rational about it. I'm not saying take no risk, but you need to be rewarded. And most professionals, the risk they take, unless that's their their game plan and they're good at it, like venture capital. You have professional venture capitalists. They will lose money on maybe 7 out of 10 deals, but they know that, and they get the one that is a huge success, and maybe a couple of them break even, or they do okay, but that's their business. And to make that judgments that they make, they have been doing it for decades. These people are the best in the world, and they still lose a lot of the time. So you're going to make, as a regular person off the street, you're going to make this decision about some startup. You have to realize the difficulty in that. So that's the idea. If there's one thing you ask for, to think in terms of risk and what risk you're really taking, because most people don't assess that risk correctly.
So where does crypto schemes, where does that, even just like say investing in Bitcoin, investing in Ethereum, where does that sit in the risk ladder?
Well, I'll give you another piece just to think about, and then I'll explain that. But when you think about investing, there's two types of investments. There's the investment where you look to the asset to produce the return. The asset produces a return. What does that mean? Well, I have real estate. And so I invest and I get cash flow from that real estate. It produces the return. Whether you're interested in buying my real estate is irrelevant to me. I don't have to sell it. The asset is producing the return to me every month, week, year. And so you could say that also about a business that you buy. If you think about the stock market, don't think about it as this gambling casino where things go up and down and you're trying to game those prices. When you think about stocks, you should think, I own a piece of the business. So you can have, those are called productive assets, real estate, farmland, a great business, either through the stock market or privately. I look to the asset to produce the return. I don't have to sell it to someone else to get a return. Now, the other type of investment is you solely make a return if someone else buys it at a higher price. That's how you get your return. So that is crypto. The asset itself produces nothing. The Bitcoin does nothing, produces nothing. There's no intrinsic value, as they call it. It's just a sentiment play that other people believe it and it'll go up, and other people will always want to buy it at a higher price. That's the only reason you buy it. The Bitcoin does nothing. It doesn't. It's unproductive. So when you say where does Bitcoin fall on that, to me, if you stay with productive assets, first of all, that's what Warren Buffett does. As well, most of the great investors buy productive assets. They don't speculate in sentiment plays or Bitcoin. It's like basically it's like a gambling token. You have to, you want to do it, fine, do it, but realize what it is. It's not productive. And the only reason people buy it, really, if you asked 1 million people, you asked 10,000, you asked 100 people, 99% of them would say, I own it. A lot of them just own it because it's unbearable for them to see it go up and they don't own any and their friend gets rich. It's literally unbearable emotionally. It's like, I just own it because just in case it goes up. Okay, but that's not investing. And the other thing about it is it's like the Bitcoin is around, the Ethereum is around, but 99.9% of these coins went to zero. It's like you're buying an asset class, all the small ones, where everyone, it's like going to a restaurant and everything on the menu, everyone dies every time they go. And then, but the meal kills everyone. and then, but you go and you say, no, but you don't understand. There's this one dish on the menu hasn't killed anybody. So I'm going to eat that. But it's just, to me, it's speculation. I have this thing called 5 levels of investor. It's at level 1. You speculate on price movements. It's very emotional. And this is not professional investing. And I'm just saying to people, like, as to be more awake of these differences. And because it's on the media all day, it's on CNBC, it's on Bloomberg, you think, oh, that's good. The government approved it. SEC says you can have a Bitcoin ETF. It must be good. Well, the government has approved cigarettes. It's approved asbestos. They used to have cocaine and Coca-Cola. It doesn't mean because the government, it's really just want people to think a little bit deeper about what they're doing.
That's really important. Yep. So where does real estate sit in the risk ladder? Because you can have lots of different kinds of real estate investments. You could be in completely on your own. You could buy into some joint scheme or whatever, where you get a piece and you're just passively sitting on the sidelines while somebody else is doing the rehabs and the property management and all that. You could do single family, you can do multifamily, you can do commercial, properties that need to I don't know, get what's the word when it's an environmental disaster and you have to reclaim the land and stuff. There's all kinds of real estate investments.
Yeah. Well, so real estate, if you own it yourself and you know what you're doing, it can be less, it has obviously some risk, but I love real estate because you really can control a lot of it. If you buy it correctly, there's certain things, I teach. I just did a real estate event. I started with real estate. I teach investing in all assets, how to analyze them. Real estate, I bought my first property in 1998. I love real estate. So it really depends, on if you're going to give money to somebody else and they're investment manager, what's their timeline and history. I would always look for people who have at least 20, 25 years, because again, in the last 12 years, the market's bottom. They had the great financial crisis, 2008. People got really hurt in real estate who didn't know what they were doing. Right? I didn't have any problems. I always say I could have slept through it because I had productive assets. I had cash flow. I wasn't speculating on price gains, which people do in real estate too. They just say, I'm going to buy it and sell it to someone else at a higher price. That's how people got wiped out in '08, because they were buying these houses, these condos, and they thought, I'll just sell somebody at a higher price. But, they couldn't rent them out to cover their expenses. And when the market turned, they lost their money. So at that time, though, if you bought real estate, 2010, 11, 12, 13, 14, you could have bought anything basically, and it went up. Interest rates were very low. Interest rates have a huge effect on the value of assets. You have to keep in perspective that that's not normal. That wasn't normal. And now we have a little bit higher interest rate environment. That's more normal historically. Even higher rates would be, even a little bit higher would be considered normal. So that affects the borrowing capability. So again, as risk, if you have in this environment, if you have reasonable debt, you made good assumptions about the real estate you were buying, the income it would produce, the expenses. It's all about those assumptions you make up front. I always say, like, investing is like part art, part science. The science is today. If you go to a property, you say, all right, it's a 32 unit property. You get an average of $1,000 a month rent in each unit. That's the science. That's a fact. You have to do your due diligence, make sure that's correct, but that's what they're telling you. Then the art of it is like, what's the competitive advantage this building has? Will it go up in value? Why will it go up? It only go up. It relatively will go up if the rents can go up. And then depending on where the risk-free interest rates are, again, risk ladder, the value of real estate will go up or down. You'll get expansion of what they call multiples, like how much will you pay for that income? If interest rates are zero, people pay a lot more for an asset that produces something. If interest rates are 5, they're now competing with 5% risk-free return. So the value of properties comes down, as we've seen. So, making these judgments about risk is the whole game. And so now if you invest with somebody else, you said, well, I could do like a syndication. This is a great way to buy properties. But what happened was you had a lot of syndicators. I always look at the history of the managers. Again, they made money when it was easy, and then they look really good. They made money 2011, 12, 13, 14, up till 2022. Now, a lot of those guys are getting wiped out now because they made bad assumptions. They assumed interest rates would be zero forever, and that's a bad assumption. So they're underwriting. They made assumptions about rents. But I will tell you this, the reason they did it, there's so much money in raising money. The money, Warren Buffett said at the annual meeting last year of Berkshire Hathaway, where I was there, and he said the money has been in raising money, not outperformance. So there's so much money made by raising money. And so I teach people, like, look at these presentations. How much is the general partners making? Do they get paid because they made you money, or do they just get paid by raising it? They're getting all sorts of management fees for doing nothing. So you have to assess this risk, make sure there's alignment if you're investing with somebody else. It's great that the general partner makes money if you do. That's fair. I want them to make money. But for them to make money just for raising the money from day one, I don't want to be in that deal. And then you have to make an assessment about their experience level. Have they been through cycles, or was it just in the last 12 years? So that's just a couple of things to think about. But I love real estate overall. It's a productive asset. You can protect your downside if you're smart. Use long-term fixed rate debt as long as you can. Don't speculate on interest rate changes. Some people say, "Oh, well, interest rates are definitely going down." Well, I don't know about that. There's a lot of history. I mean, we could get into that, but you look at history to see how these things happened in the past.
Good stuff. Really good stuff. So if now you mentioned competitive advantage when we were talking about real estate, which brings up a really good point. My understanding of Warren Buffett's style of investing, where you're looking for moats, durable competitive advantages, such as a brand moat, such as a toll booth moat, et cetera. You can apply his principles to real estate investing. And I don't know that people do that enough. So maybe you could give us an example where it's a little outside the box to think about applying Warren Buffett's style of investing to a real estate investment.
Yeah, so it's a great point. And at the event I did just the previous weekend, about 10 days ago, I spent the first hour or so going over principles of Berkshire Buffett. And the reason I did it is because he compounded returns for 57 years at over 19% a year. They said people made money 30% a year for 20 years. Well, that's incredible. I'm not knocking that. But there's something to be said over 57 years of compounding at over 19%. And let me tell you, you will be plenty rich if you could do that. So his principles work through many cycles. So what's an example of that? Well, you mentioned, and I mentioned durable competitive advantage, sustainable competitive advantage. Is another way to say it. It means, are you going to get earnings, income from these properties through different cycles? And when you look at it, let's say, people, that's been really popular to invest in Dallas or Texas. And I know, and I understand why, and I'm not knocking it. People have made money, but there's also tons of land. There's tons of land. Dallas, they said, had the most empty lots. So now, what happens when returns are good? What happens? People start building new properties. So, and I'll show you a counterexample of that in a minute. But in Texas, you have rents going down. There's a lot of new supply. So all the assumptions that made it wasn't maybe a durable, sustainable competitive advantage. I talk about 4 strategy investing. Number 1 is buying in the best areas at a reasonable price. Warren Buffett said, "I'd rather own a wonderful company." Just replace company with property. That's it. Anything Warren Buffett says, because a property is a business. He's buying whole businesses, but a property is a business. It's a simple business to understand. You know your rents, you know your expenses, and that's it. So it's a simple business to understand, and that's that's easy to do. So just replace it. But he said, "I'd rather own a wonderful business at a fair price than a fair business or property at a wonderful price." But in real estate, if you, like in New York City, it's very hard to build and take and undercut my rents. First of all, there's not a lot of land. You all know that. If you assume Manhattan or Brooklyn, where I'm at, so you have to buy a property. And you have to build. You're going to build at much higher cost than my property is. I have older buildings. And so you cannot compete with me. I have a durable competitive advantage. You cannot charge lower rents than me. There's a limited supply. It's hard to build. It's expensive to build. So through different cycles, as long as you don't have too much debt, you don't have bad debt that's coming due, you can sustain through multiple cycles and compound and build real wealth. That's the idea of Buffett, sustainable, durable competitive advantage applied to real estate. So in an area where you can build a lot, you don't know that that's true. So if you have land and land and land for miles, and you're buying a property and you're saying, "Oh, my rents are good now." But what if they build all around you? And what cost are they in at? So that is something just people don't maybe take into account as much. when they're thinking about real estate, but it's really true.
Yeah. Now, one thing that I was really impressed by is you had explained in one of your trainings how you were able to buy a property, a really nice property, undervalued because of the way that they had calculated the square footage and the price per square foot. Do you want to share a little bit of detail on that?
Yeah. So when I came to Florida, so I lived in New York City my whole life. I came down here in April 2020, right when the pandemic started, for various reasons. One being quality of life, and the other was selling my business, and they put the deal on hold. So I said, you know what? Let me go to Florida. I'll close when I'm in Florida, and I want to live here anyway. So I always wanted to live here. So I came down, and I was looking for kind of to recreate what I did in New York City, buying in areas that were transitioning, got higher, more, went up a lot, and rents went up a lot, and that worked really well. But down here, what I started to notice also was that there was what you were referring to as the single family housing market here. There's very bad housing stock. There's not as many choices for people. We're used, if you're from New York area, you can go to many, many suburbs, buy a nice house. So down here, I went down, and the way to buy single family houses is to look at the comparative price per square foot, let's say for a 5-year history, which is what I do. Now, the brokers will tell you that's crazy. You cannot get 5 years history. Let me tell you what it sold for 6 months ago. Well, that helps them. It doesn't help you, because if prices are very high, like they went up in the pandemic, they went down and then they went up like crazy, as we all know. So if you bought at just looking at a short history, you wouldn't know. So down here, like for instance, the house I'm in now, and I did another deal like this, but the house I'm in now, I looked, or actually I'll talk about the one I bought in Coconut Grove area. So the 5-year history was $500 roughly a square foot in that area for single family homes. By the way, if you go waterfront or something extraordinary, price per square foot goes right out the window. You can't use it because there's such, it goes wild at that point. You could have wild ranges in prices, but you have to make sure you're comparing. But it was 500 a square foot. I was able to buy it. I looked at the 5-year history. I was able to buy it at $480 a square foot. So I felt like I was under the 5-year history, and then I made some improvements to it. And then also the prices actually went up a lot in Coconut Grove. So that house I sold immediately for much higher price. And so I look at price per square foot. I look at replacement cost. If you see things sitting on the market for a while, obviously that might be an advantage. When I buy houses, I don't go with a broker. I sell with a broker, but I don't go with a broker because I like that competitive advantage that the broker who I'm buying from will make more money. The seller will make more money because I have no broker with me. So there's all sorts of things.
So restate that again, because that's a really important point. That if you're using a real estate broker to buy a property versus you're coming in without a broker, that makes a huge.
It does give you an advantage, and several deals I did like that. Now, commercial properties, even there maybe, but specifically in single family homes, I went in, and in both cases, in the two cases I'm thinking of in Florida, where I bought a single family home, I went myself, and when I got there was other offers, but the broker wants to do the deal with me, so I could even get less of a price, and the broker makes more money because he doesn't have to pay 3% to my broker. I don't have one, so the broker split the commission, right? So it's just one thing you could do. Look at the history, look at replacement cost.
Right. So you're actually better off to not use a buyer's agent when you're looking to buy single family real estate.
I would say if you have time to look and learn the market, I always say become an expert. I enjoyed it. If you have no time to look and you go on your own and you're not going to do any research, well, you might be better off having a broker. But again, I can get an advantage going in and bidding on a property without the broker in many cases. It might not work all the time, but a lot of times they'll want to do the deal with you.
Yeah, they'll make twice the money.
Yeah, they make twice the money, or they make more than sometimes there's a deal they have with the seller. If it's direct deal, they get a little less, but they're still making more money. So yeah. So that's a small thing, but price per square foot is really important in single family houses. You met to as a metric, But there's other metrics, but
Well, sometimes though the value is calculated in a way that it's undervalued, and you can go in and get a great deal. So how does that happen?
well, like for instance, the house I'm in now, I bought from a Major League Baseball player. Now he put $500,000 into video and audio system in this house. There's cameras in the corner of the property. It's a couple acres. They follow you around if you're walking. But this is nowhere mentioned in the ad. So sometimes you see things marketed very badly. And then I went in here and I thought, well, there's two buildings on the lot. There's the main building. There's a guest house building with a batting cage, which is attached to it, where I actually did my event. I was telling you, in the batting cage, obviously all the equipment was removed, but it's a really cool building. Now, that's about 7,000 square feet, but they only give you the square foot legally. The batting cage is not like a living space. So they're giving you 54, whatever it is, 52 square, 100 square feet. So I'm looking at that, and I'm also looking at, replacement cost. My lot is landscaped very nicely. If you were to build, first of all, if you had to buy this lot, it would cost you maybe $1.5 million if you can find it in this area. So the area is desirable. So I start thinking about, well, if I could get the lot and build my own house. Now, if I want to build 7,000 square feet, what is that? In Florida, maybe it's $400 a square foot. Let's say it's $350 a square foot, and I'll build 7,000 square feet. So, or 300 square foot, that's 2.1 million plus the lot. That's 1.5. Now I'm at 3.6. Again, this is not an exact science, but it helps to think about your replacement cost. Now I got to put in the landscaping because that's a lot of money. I spent a lot just to maintain the landscaping is a lot, but to put it in, you're talking several $100,000. Now I want to put in the video system and the audio system that he put in. So right away, we're almost at $5 million. And, I could buy that. I bought the house at much less than that. So I feel pretty good about that. I feel pretty good about it that I fixed some things here, and it's worth more. So everything I do is like trying to look at value, like real value, valuing assets. Single family is different than commercial real estate, obviously, but that's one. Those are a couple ways to value single family homes and to make a good purchase.
That's great. So, could you tell us a little bit more about your 5 levels of investing framework?
So the 5 levels of investor was something that I came up with recently. I woke up in the middle of the night after mind-numbing conversations on the WhatsApp group. I think you're in there. We have this public WhatsApp group, and with the crypto folks, I just couldn't take it, and I just had this idea. There's 5 levels of investor. That so you may go through different cycles, different levels. Hopefully you can get to at least level 3, and I'll explain. And hopefully everything I'm doing will get, if you listen to what I'm saying, if people listen and they get to a level 3, which is awakened level, you'll realize, hey, there's more to this than I thought. But level 1 is basically the speculator or the gambler. So it's speculation is a nice way to say that you're gambling. And there's people who are very good at speculating. There's traders on Wall Street. I worked with them. They're very few and far between. It's like an Olympic sport. It's very hard to do. Whereas investing, what Buffett does, you can do reasonably well, and you don't have to be a genius. It's more about, as Buffett says, more about temperament than IQ. It's more about temperament. It's the controlling your emotions than the IQ level. It's not, you don't have to be a financial analyst. I teach people valuation skills, simple ones, basic, because it helps to know some if you want to go down that road. So level 1, speculator, gambler, they're always looking at price movements. They're very emotional. They're always on to the next hot thing. They're always into what's hot. They heard it was good. They buy it. And they often take big losses, but a lot of them don't learn from that. Many do, but some don't, and they're right back into it, the next bubble. I always say, and on it goes. Today, it was crypto. It was real estate got crazy. It's going to be something. It's going to be AI offerings. There's going to be all sorts of AI companies that you just have to be in. That's what it's going to seem like. People are going to be getting rich in something else. It's going to go on forever. From here till the end of your life, there's always going to be. So the speculator gambler is always going after the hot things. Now, the second level is retail investor, they start, they might go there and they give their money to a financial advisor, which is fine. They hope that the person does well. They don't have a lot of understanding, but why markets move, why prices go up. They don't have the understanding, but they get some other people to help them. And they also might get now and then involved in the speculating, the gambling, because they heard or they saw their friends. So they don't have control of their emotions. And that's most of the crowd out there. Then what happens is usually with the retail investor, they might have a loss and they start thinking, you know what, I need to learn more. And they might have a big loss. Actually, they went to speculation and they think, you know what, I don't want to lose my money. So, and maybe they come to me or they learn something or they read Warren Buffett and they become sort of awakened. They awakened level 3 investors like, you know what? There's more to this. I cannot just do wild things and like, oh, my buddies are making money and I do it and it's just going to go up. It's like you start getting like woke up and you're like, you know what? I got to be careful. I want to preserve my money. I work hard for my money. I want to invest it reasonably, but I don't want to have these big losses and I don't need them. At that point, you grow up a little bit, right? And you're like, you know what? I don't need, but I want to grow at a reasonable rate. So that's the awakened investor. And hopefully you get to that point because that is a huge thing. To just have that realization is a huge thing. It keeps you out of trouble doing stupid things. And you start to have some judgment about probabilities of success. Maybe you learn a little bit about asset valuation. Then if you really want to go farther, the next level is professional investor. They can look at all assets. They understand cycles. That's more work to do that, but you can do it. You can at least get, and you might just be a professional in one asset, real estate. A lot of people just stick with real estate and they do fine with that. So you learn more, you understand cycles, you understand how to value things. You're not married to one idea, one asset. I'm always looking for what's dislocated at the time. And sometimes it's certain things I think are undervalued. And I don't have a bias. I try not to have any bias about anything. I would try to just see things clearly as a professional investor. And then the 5th level is the master. The masters actually built investments themselves. They didn't inherit it. And they live off those investments. And they have a perspective which, is only that a master can have because they've been through cycles. They've been through ups and downs, but they have proven that they can do it correctly. The funny thing about, just to finish, the speculator, sometimes they think they're the professional. There's many traders and there's trading programs where they teach you, oh, you can trade, it's easy. But the money's made selling the programs for 98% of the people. So I think it's very accurate and it just came to me and I think it's really true. So hopefully that's helpful to think about a new way of these levels of investor.
Yeah. Now you said you have this question in your mind, like what's dislocated? What was that? What's the context of this for our average listener? How are they going to think about this when they see an opportunity to invest? What kind of question will go through their head?
Well, I would say this: when you look at if you watch CNBC, which I don't suggest you do, because there's always somebody every minute. There's a new speaker. Now, sometimes they have the great investors on there, Dalio and stuff, and they're worth listening to. But most of the people on the show, they tell you, this is what's going to happen. This is what's going to happen. Buy this, sell this. And it's mind numbing. So, when I look for dislocations, I'm thinking about contrarian thinking. Because there's certain times, so contrarian thinking is looking at what people aren't talking about, but is actually really good. So periods of time, even in real estate, look at 2008, everything crashed out. That was the time a lot of people got burned. They hated real estate. And that was the time to buy if you look at the history. Like you could buy things at very cheap assets because people were burned. If you think about real estate right now, it's not entirely the case yet. There's a lot of people still waiting for that opportunity. That's not usually where they happen. So to get dislocations, it's usually when something is hated Or now some things deserve to be hated. Let me be clear. Just because something's hated, it doesn't mean it's a good deal. You have to go to another level on that. But just to look, when everyone's on one side of the boat saying, this is it, I want to go to the other side of the boat and say, what are people ignoring right now? Like, for instance, emerging market stocks have underperformed pretty badly to the U.S. markets for the last 10 or 12 years. But some of these assets here trade, they're businesses that you can buy, publicly traded companies, and they're very cheap relative to U.S. markets. So it's like, but not many people are talking about it. People actually hate China, and there's reasons why, I understand. The stocks are very cheap. I'm not saying that, there are real risks there, but you can buy companies. Let me give you an example. If you have a business, just think about it. Anybody here is listening who has a business. If you had a business and I offered you and I said, I will pay you 2 times your cash flow for your business. Now, people who have a good business that has good cash flow, they'll laugh at me and say, I'll never sell you my business at 2 times my cash flow. I'm making a lot of money. You got to pay me 5, 7, 8 times. But there's publicly traded companies that sell at 2 times cash flow. You're like, why would that be? Now, depending on the business and the industry, and you have to make a judgment about the company's future and the business future, the industry they're in. But there are things that trade on public markets that are super, seemingly super cheap. So you can find these assets, but they're not talked about really. So at any given time, I'm looking for what are people ignoring and what is the value. And it can even be, back in March, I told people in my master's group, my HDI master's group, which we learn how to be a professional investor. And I told them, these AI bubble, because I recognize patterns from history. I lived through the dot-com bubble. I said, this is probably going to turn into a bubble. I would own all these companies, what they call the Magnificent Seven. Now, I wasn't exactly super early, but the stocks went up anywhere from 30 to like 150% since that point, because the value, even though they were already known, it wasn't like people didn't know this company. So but what wasn't realized, which is the other side of contrarian, is thinking, what could happen to these companies with productivity gains of AI? If I own a business and I can cut 30% of my staff, what happens to my earnings? Even if my revenue's flat, my earnings go up. And all businesses are priced on the earnings, the free cash flow they generate. Roughly speaking, that's what you want to look at. Now, markets can get extreme with emotion or extreme down with emotion. So it goes disconnected from the cash flows. So I can give you one more example. Jeff Bezos said in Amazon, I think it was 2000 or 2001, the stock went from $100 to $6 roughly. And he looked at his sales. His sales went up the next. He goes, my business didn't go down by 94%. So when you understand how to value assets, it's hugely powerful. How many times do you need to recognize something like that and purchase it to build real wealth? And I always say you don't need a ton of investments. You need a handful of good ones. And then that asset has gone up huge over the last 23 years. Not easy to recognize in the moment. I'm not saying it's easy. But if you recognize that business was great, and then the price, even the last year, Tesla was at 300 and it was at 100. Was Tesla's business gone down by 2/3? Was it too expensive at 300? Probably. Was 100 relatively good price for Tesla? That's the skill, the art of investing, is being able to get out of the emotion and look at the actual business soundly and rationally.
And your best deals aren't going to come from watching Jim Cramer.
Yeah, probably not. It's just not realistic. That when it's on TV and everything, and that's the retail. Retail goes into that. The retail level. Oh, it's on TV. It sounds hot, and they do it innocently. And I'm just trying to make people more aware of kind of, what is involved.
So you mentioned free cash flow, and that reminded me of something I learned from Keith Cunningham about that all cash is not the same. And he was teaching operating cash versus investing cash and other types of cash. Can you kind of encapsulate that in a short little lesson for our listener?
Yeah. So when you look at, if you think about, Ray Dalio said this at Tony Robbins' event, Platinum Finance event, which is the best event. He has speakers. He gets, the best speakers in the world. They say things you're not going to hear anywhere else. And he had Ray Dalio came on. Ray Dalio said this very simple thing, which is very profound. All investing is a lump sum payment for future cash flows. And even I didn't even notice that. So Tony actually repeated it after he said, "Did you? That's what Ray said." And I was like, "Wow, that's profound." So you're laying out money. It's simple. Everyone, you should know it, but it's like, think about it. You're putting out money today for future cash flows. So the free cash flow a business generates is how you value it. Think about it. Real estate. You say, "Well, I'm gonna put $100,000 in this property, and every year I get $10,000 after all my expenses in my pocket. That's the free cash flow." So I get 10% return. Now, what am I willing to pay today for that return? Basically, when you think about a business, you try to determine what the free cash flow is of the business, and you could see it like on Yahoo Finance. They'll tell you the free cash flow, and then you could see the history of it. And then you look at the market capitalization of the company, which is actually the price of the company. When you look at stocks, the ticker price is irrelevant. People say, "Well, Tesla's at $214. I'm paying $214." No, you're not. You're paying, I think it's like $700 billion for the company. That's the market capitalization. So all the shares outstanding times the price. So I didn't get too deep into this, but when you look at the free cash flow it generates relative to the market capitalization of the company, the value of the company today, that is your free cash flow yield. So you can find companies that are at, have 9, 10, 11, 15% free cash flow yield. It's just, for most people, they don't look at it necessarily like that. And they think, well, I like, basically like real estate, the cash goes right to your pocket. When you own a stock, the company makes money and they might not pay it out. When they pay it out, it's called a dividend, but they may reinvest that money and grow the value of the company. But when you're looking at price movements, you don't think about that. What I'm trying to tell people is look at the stock as a piece of a business and try to understand the business. That's what Warren Buffett does. I didn't make this up. This is, Buffett style. And many value type investors, which I think, by the way, the term value investing is a misnomer. All investing is you want to get value for your money. So I think that they put that idea into a box. Again, the tech companies could be valuable because their free cash flow is growing compounded. Like if Nvidia, it is expensive. I'm not telling anybody to buy anything I'm saying, because I'm just using examples. But Nvidia, their free cash flow was like almost, doubling. And so then how long can they do that for? I don't think forever, but the build out of the AI infrastructure is a massive thing. It could be bigger than the build out of the internet. So again, those stocks are high priced. I'm not saying they go up. They could easily go down. I could give you a lot of reasons why they would go down.
Yeah, that's great. Well, I know we're getting close to time, so I want to go in to a little bit of depth for a few minutes on it's relating to crypto, and it's the whole idea of staking. And this is something where people can lose big because, for example, you buy at a high price, you now own this token, and you stake to get a return, and that becomes income, taxable income, whatever your staking rewards are. And then the price plummets. You still have to pay for what you earned in the income from that staking at the crazy price that you paid it for. Now the bottom has fallen out, and what you invested in is it's practically worthless, but you're paying taxes on all that staking that you did.
I mean, it's just people lost their damn minds. I don't know. Like think about it. I tell you, give me your money, and I'm going to pay you 40% a year in interest. Okay, how? Like, my graduate goes, how are you doing it? And I could never get an explanation. So I asked. I'm not against it just for the pig being against it. I did a lot of research. I said, what am I missing? I do all the analysis. I said, try to see, am I missing something here? But basically what they did was they lent the money out to other crypto traders who traded it. So it's like this, but it all depends on the prices of all these coins keep going up. Again, it's not a productive asset. The asset does nothing. So they're telling you this, and then you pointed out when it all goes down, you made money, and you're paying tax on the money you made, but you lost your, you lost your principal maybe the next year. So you paid the tax, and then the next year maybe you could take a tax write-off. But you just have to. I always say there's not a magic money mill in the rainbow and unicorn forest that produces cash. And people tell you this, and I'm like, oh, that must be the magic money mill. It's like, where does the money come from? It's a Ponzi. It's always been a Ponzi. You get the money in. As long as people keep putting money in, the crypto coin goes up, and then they can lend it to traders who trade that crypto coin as long as it goes up. But if it doesn't, it all implodes, and it implodes quick. And that's the problem. People who do it, they're all going to run to the exits at the same time. That's typically how it happens. You don't know what happened, and I'm not saying it doesn't go up. I never said once that Bitcoin can't go up, because I will tell you this. People love to gamble. They love it, and it's unbearable, again, emotionally, to sit by and watch other people make money. It's unbearable for most people. You can't watch your neighbor getting rich, supposedly, and you're not doing it, so you have to buy a little piece. And then that can go on for a long time. Look at Vegas. Everyone knows you're likely to lose your money when you walk into the casino, but you go anyway. It's fun. They got shows. They got great food, the excitement. You take a shot, you did it, and you make a little, and if you stay long, you're going to lose. Everyone knows it, but it's packed every day. The building costs $2 billion. So it's not rational, but people love it. They love to gamble. And so I'm saying, if you want to have fun and gamble, go to Vegas. It's more fun, actually. You can have food. You can have a show. You can have you buy this coin. It sits on your computer. You never see it. You've never seen it. Does nothing. It's not fun at all. It's just like this thing that's there. Apparently, it's in a wallet somewhere. And you hope it goes up. And it could go up. It's just, in the end, it depends on the prices that someone who buys it from you has to believe it's going higher than you sold it at. And that has to go on forever. At some point, it can't, but if it has to for everyone to make money. So what happens usually at the top of these staking or crypto schemes, they run for the exit. So when did most people buy Bitcoin? When it was in the 60,000s. The records are clear. And then it went all the way down. People sold it. And then, on and on it goes. And here it goes back up a little bit. So who knows what happens? It goes up, it goes down. It's just not a game I play. I like to sleep at night, and I can make a lot of money actually doing sound investing.
Yeah, all good stuff. Amazing. So if our listener wants to keep learning from you, you've got some training programs, you have a community, mastermind, and so forth. Where should we send them to?
Well, you can go to holygrailinvesting.com, holygrailinvesting.com. If you put your email in there, you can read the 20 rules to know to stop making dumb investments, which is a good start alone, just to realize all these different ways that you can avoid bad things. I always say avoid the really bad things first, then learn how to spot the truly great opportunities. That's the idea here. And so that will help, and then you'll be on a list if we do some things online or now and then, and I don't really do events. I did 2 in my one last year and 1 this year, and but yeah, that's basically it. Go to holygrailinvesting.com and you can stay in touch.
Awesome. Well, thank you so much, David. This was really enlightening, and hopefully it saved somebody's bacon. I bet it did. So, yeah, thank you for all you do, all the light that you reveal in the world.
Thank you, Stephan. Good to be here.
Okay, and thank you, listener. So spread this message for people to be smart with their investing, and we'll catch you on the next episode. I'm your host, Stephan Spencer, signing off.